Have you noticed something strange happening lately? While crypto prices have been wobbling, Bitcoin sitting at a multi-month low, and fear is creeping back into the market, governments around the world have quietly started focusing on something far more important than price: taxes. Not the exciting chart-pumping kinds of news, but the kind of news that can wipe out your profits even if you're a good trader. If you're new here, I'm Paula. I break down everything happening in the crypto world, the markets, the manipulation, the geopolitics, and the real stories that actually affect you as an investor. And today we're diving into a topic that barely gets talked about, but every single crypto holder needs to understand. Because 2025 is shaping up to be the year governments stop arguing about whether crypto is the future and instead start taxing it properly. Not new rules, not proposals, actual enforcement, real data sharing, real penalties, and real consequences if you get it wrong. And what we're seeing now across the UK, the US, the EU, Asia, and places you would never expect is honestly a bit shocking. And by the way, because so many of you asked incredible questions on my last YouTube video, I'm doing a YouTube live this week with Jamie, the award-winning UK crypto tax accountant. We're going to tackle everything from staking to mining to bots to airdrops, international trading, bridging, losses, write-offs, all the stuff no influencer ever explains properly. But for today's video, let's start with something surprising. Crypto cycles come and go. We've seen FTX, Luna, ETFs, Bitcoin halving, booms, busts, and everything in between. But governments don't move in cycles. When they change their approach, they don't go backwards. 2025 isn't the year crypto gets regulated. It's the year crypto gets monitored, tracked, and taxed properly for the first time on a global scale. For years, governments ignored crypto because they didn't understand it. Now they understand it. Now they've watched the money flow, they've watched the profits, they've watched the mistakes, and they've realised one thing. Crypto is taxable, and taxable things equal revenue. And trust me, when a government needs money, they will find it. This brings us to the perfect place to start: Iceland. Iceland is tiny, but its crypto tax policy is huge. They've become one of the strictest crypto taxation countries in the world. Heavy capital gains tax, aggressive reporting requirements, minimal forgiveness for mistakes, and extremely tight enforcement. But why does this matter? Because Iceland is often a first mover in financial policy. After the 2008 crisis, Iceland was one of the earliest countries to clamp down on banking malpractice. They tend to act early, and Europe often follows. Iceland's stance is like a warning light for the rest of the world. Crypto gains are not slipping under the radar anymore, and they're not alone. Let's talk about home, the UK. The UK technically has some of the clearest tax rules anywhere, but the problem is that the clarity hasn't made it easier. It's made it more complicated. HMRC now treats crypto activities differently. Staking rewards, taxable. Mining rewards, taxable. Airdrops, taxable. Bridging assets, sometimes taxable. Swapping can be taxable. Trading one coin for another, taxable disposal. Using bots, depends on intention and volume. Moving assets between your own wallets, usually fine unless they classify as a change of beneficial ownership. This is exactly why I'm bringing Jamie onto my channel for a proper live session, because the questions you've asked me recently have been amazing and also terrifying, because so many of you are unknowingly doing taxable events on a weekly basis. Misreporting used to be easy for HMRC to miss. Now, exchanges will automatically report data. HMRC has bought blockchain analytics tools, and wallet tracking is becoming standard. 2025 is not the year you want to hope for the best. If the UK is strict, the US is confusing. There is no single rule, there's no unified approach. Instead, you have a patchwork of federal rules, state rules, and IRS classifications that seem to change every 6 months. So here's what's happening right now in the US. Mining is taxed differently in different states. Staking is taxed before you even sell. Airdrops are treated as income the second you receive them. Swaps between chains or tokens can trigger taxable disposals. Constructive receipt rules mean you can owe tax before you've made real money. The US government knows crypto can't be ignored anymore. And because of the size of the US economy, whatever the IRS does, other countries copy. And Europe? Well, it's all over the place. Germany used to be a tax paradise for crypto, but not anymore. Portugal used to be a crypto haven. Now that's closing up. Spain introduced strict foreign asset reporting rules. France tightened tracking requirements. The Netherlands goes hard on classification. And then you've got countries like Belarus pushing state-run crypto mining to break dependence on the US dollar. This is where crypto stops being just trading and becomes geopolitics. Crypto taxes tell you what a country thinks of crypto. Some sees it as a revenue, some see it as an opportunity, some see it as a threat, some see it as leverage against global powers. And that's why every tax rule looks different. Each country has a different motive. Here's the part that surprises most people. Governments don't need to catch you. They already know. Because exchanges are required to report. KYC is now global. Chain analytics tools track wallet movements. Tax agencies share data through international treaties. Blockchains store transactions forever. Nothing disappears. Once your crypto touches a KYC'd exchange even once, that wallet becomes traceable. Even if you use DEX's privacy tools, multiple wallets, the thread still exists. This is why tax planning matters just as much as trade planning. Because you don't want to make money. You want to keep the money you make. Here are the biggest mistakes traders make, and the ones that Jamie sees consistently. Number 1, thinking you only pay tax when you cash out to fiat. Wrong. You're taxed when you swap one token for another. Number 2, thinking staking rewards aren't taxable until you sell them. Most jurisdictions tax them the second they hit your wallet. Number 3, thinking bots count as passive income. Sometimes they do. Sometimes they count as trading activity. Totally different tax treatment. Number 4, thinking losses don't matter. Losses can offset gains, but only if reported correctly. And number 5, thinking that no one will notice. In 2025, everyone notices. Everything is tracked, the blockchain remembers. This is why this topic matters right now more than it ever has. So this week I'm hosting a YouTube live with Jamie, who is honestly one of the best crypto tax accountants in the UK. Not a guru, not an influencer, a real award-winning specialist who deals with this every single day. And he's going to break everything down for you. But I want your questions. Comment them below. Whatever you're confused about, staking, trading abroad, cashing out, NFT sales, drop them in the comments and we will do our best to cover it live. This is your chance to speak directly to somebody who actually knows the law. If you found this video useful, hit subscribe. I post daily updates on the crypto markets, the news, the macro picture, and the things that actually matter. Thank you so much for watching, and I'll see you guys on the next one.